Alright guys, welcome back to my YouTube channel. My name is Philip Oyedele, and on this channel we talk about faith, family and finance. And guess what? I'm here with another wonderful piece for you guys. Today I'm going to be giving you the juice about ETFs investing. What are ETFs? Why should you invest in ETFs? And what are the things you need to look for when you want to make an investment decision about ETFs investing? So ETFs are exchange traded funds, and guess what they are? What do we even mean by exchange traded fund? Consider them as basket of companies. Let's take for example S&P 500 is a popular ETF. Virtually everybody knows the S&P 500. Now in S&P 500 is a basket of 500 different companies. So when you invest your money in SPY, you are literally indirectly investing in 500 different companies. So take it as you are diversifying your risk. These 500 different companies operate in different sectors. They have different market capitalization. They have different PE ratio. They have different DE ratio and all the rest. So that gives your investment a very wide margin, giving you low risk. However, not also giving you a lot of return. Remember, the risk to reward principle is low risk is low reward, and high risk is high reward. So when you invest in an ETF, you are investing in baskets of companies. And the benefit of ETF investing is you have low risk and your investment is well diverse across sectors, across different companies, across companies with different market capitalizations. So this is why you need to invest in an ETF. Now let's go to the real juice of this video. What are the things I need to look out for when investing in an ETF? First, you want to check the percentage distribution. Percentage distribution shows you how the ETFs is distributed across different sectors and how your investment is going to go across. Okay, so let's take the S&P 500 for an example. The S&P 500 has 30.86% in technology, 14.13% in financial services, 11.02% in healthcare, and you can see the other distributions. Now, another thing you can check is top 10 holdings. What are the top 10 companies, the big boys of these ETFs? Look at all of them. The Apple, the Microsoft, the Nvidia, the Amazon, Berkshire, Meta, Google, Tesla, Broadcom. You're sure that, yeah, you're playing the game with the big guys in the industry. And look at another thing. All of these guys constitute to 33.55% of the total assets in these ETFs. What a way to have a diverse portfolio. Can you imagine? So when you invest any money in SPY, it is literally distributed across all of those sectors in those percentages, minimizing your risk and giving you a good investment portfolio, a good diversification. Now let's also consider the VOO as an example. The VOO is the Vanguard S&P 500, and it also tracks the largest US 500 companies in the market. Okay, so if you look at it, very similar to SPY, technology is 31.03%, financial services is 14.15%, healthcare 11.02%, communication 9.33%. You can see that you have a good distribution across these percentages. So when you invest $1,000 in these ETFs, it's telling you that 31% of that money goes to technology. 14.15% of that money goes to financial services. Do you understand it now? Look at the top 10 holdings: the Apple, Microsoft, Amazon, Nvidia, Meta, Berkshire. You see, very similar to the SPY, right? So you need to look out for the percentage distribution so that you know how your money is going to be distributed across several sectors. The second thing you need to look for is what we call the expense ratio. You want your expense ratio to be as low as it could be. So what is expense ratio? An expense ratio is how much of a fund assets are used to administer and maintain the fund. For example, if you invest $5,000 in an ETF with an expense ratio of 0.04%, it means that 0.04% of your investment is going to be the maintenance fee that you'll be charged. That means you'll be charged $2. 0.04% of $5,000 is $2. Annually, you're going to be charged $2. So what do you want to do when you're looking for an ETF? You want your expense ratio to be as low as it could be. All right? 0.02, 0.03, 0.04, 0.05, those are very good. In fact, up to 0.1, that is still good. All right? So you want your expense ratio to be as low as it could be. The third thing you need to look out for is what we call the PE ratio, the price to earning ratio. The PE ratio or price to earning ratio is a valuation metrics that measures how much investors are willing to pay for each dollar of a company's earning. The PE ratio shows you a company that is overvalued. So you want a PE ratio that is not very high, but not also very low. You know, something maybe 20, 23, 25, 27, 30. You just want a stable PE. You don't want a very outrageous PE ratio, because that means that stock is overvalued. Investors are probably not going to be able to afford it. People are going to think that, oh, I'm waiting for it to dip and this is overpriced, I'm not buying it. So if you look at the VOO has a PE ratio of 23.46. However, the expense ratio is 0.03%. Can you imagine? But look at the SPY. The SPY has 0.09% expense ratio and 23.43 as the PE ratio. Now, Invesco QQQ, this is ETF that is technological focused. About 51% of these holdings is in technology, right? So Invesco has 28.58 PE ratio and 0.2 as the expense ratio. Now, if you look at the SMH, the Vanex Semiconductor ETF actually has maybe a little bit high PE ratio, about 37.49%. But because the Vanex Semiconductor SMH ETF is actually just across 25 companies. You see, it's not like a mega big, it's just focused on semiconductor, just 25 companies, largest semiconductor publicly traded in the United States. So it has a PE ratio of about 37, and the expense ratio is 0.35. That is still fairly moderate, but basic rule, you want a low PE ratio and you want a low expense ratio. And lastly, you want to check what we call the annual return. Now, ETFs will not definitely give you like crazy amount of money, but you can use it as a savings account. This is what typically all of us, every investor, this is what we do. You take the ETFs as basically savings account. It's better than a high yield savings account. It's better than putting your money with the big banks that will give you maybe 2% per annum or 3% per annum, right? ETFs will typically give you between 10 to 15% per annum, which is averagely okay if the market performs very well. Like last year, the SPY, the VOOs, all of them, they gave about 25% returns per annum, and that was really good, right? ETFs will not give you like crazy 100%, 250%. No, you can just use it as your basic savings account. It's better than putting your money with the banks. Banks is going to offer you maybe 3% per annum, 4% per annum. You don't want that. So typically, we all use ETFs as our savings account, and you too, you can start the game like that. So before I go, let me give you some other ETFs that you can also research about. You can research the SDY, the SCHD, DVY, VYM, the VTI, the SPD, the VUG, the VIG, and the popular SPY, VOO, Invesco QQQ, and the SMA. Those are good ETFs. You just want to check them out. Don't forget, check the holdings, check the percentage distribution, check the expense ratio, check the PE ratio, and check the annual returns. And then I'll see you again in my next video. Don't forget to subscribe to this channel. I'm going to be giving you amazing information that will reshape your finances. Let's make this money together. Share with a friend, drop a like, drop a comment, and I'll see you next time.